They told you nothing happened. They told you it was just another quiet session. But today, two doors swung open at the same time. Shanghai came back online after 10 days in the dark, and the US delivery machine finished locking in February silver. And the moment both systems reconnected, silver started lifting while gold slipped. That divergence is the signal. It shows up when the market is being forced to admit something it's been hiding. Welcome back. No fluff, just the mechanics, the numbers, and what they imply before Friday. Because if you hold PSLV, you are not watching a normal price chart right now. You are watching a stress test happening inside vault reports, delivery notices, and the spread between paper promises and actual metal. 3 days ago, the framework was simple. Watch Shanghai's reopening and watch COMEX delivery finalize. 2 events, same morning, same metal. Today, those 2 events arrived. Shanghai reopened after a 10-day Lunar New Year blackout. COMEX moved through the February delivery cycle, and silver pushed higher intraday as this is being recorded. That setup didn't need a miracle. It needed a reopening and a settlement window. And it got both. Now the real question isn't, did it happen? The question is, what happens next, before Friday? Let's start with what hit the tape today so we're all looking at the same picture. Shanghai is back. The Shanghai Gold Exchange and the Shanghai Futures Exchange reopened after roughly 10 days of closure. That is not 10 days of demand disappearing. That is 10 days of demand compressing like a spring. Industrial users don't stop building because of a holiday. Hedge books don't freeze in time. Institutional rebalancing doesn't politely wait for Western traders to feel ready. It queues up, it recalibrates, and then it releases. And when it releases into a global physical market that's already tight, it doesn't whisper. It leans. You can see it in the cross-asset behavior. Gold was down on the session. The dollar was flat. Stocks were mixed. And silver. Silver was the one asset pushing higher. That is not risk on. That is not macro optimism. That is physical gravity. When silver outperforms gold on the very day China comes back into the room, it's not coincidence. It's pressure. Real-time buy-side pressure from the side of the world that consumes metal, not just paper. And here's the trap. During the holiday blackout, Western pricing can look calmer than reality. Shorts get extra room. Paper can push the screen price around with less immediate pushback from Asia. People stare at New York and think the whole planet is New York. Today, that pushback returned. Now pivot to the other door that matters, COMEX. Because Shanghai can tighten the spring. COMEX is where the spring either snaps or gets welded shut with forced cash. As of the latest snapshot in this cycle, COMEX registered silver sat around 88.79 million ounces. Registered, deliverable. The category that matters when someone says, "No, I want the bars." That number is already small. But it becomes dangerous when you attach it to what sits above it. March open interest was sitting around 130,490 contracts. One contract represents 5,000 ounces. That's roughly 652 million ounces of paper claims floating above under 90 million ounces of registered metal. For every 1 registered ounce, there are roughly 7 paper ounces that can legally demand it. 7 to 1. That is not a normal market. That is a promise stack. And Friday is the day the market finds out how many people want to turn a promise into metal. Friday is first notice day for the March contract. That's the deadline where a holder who wants physical delivery has to formally stand and declare, "Deliver." And once a meaningful number of contracts stand, COMEX has one job: match those demands with registered inventory. This is where the story stops being price action and becomes math. Now let's make the math real, not abstract. In the last 30 days of this window, registered inventory was reported to have dropped by roughly 51.9 million ounces. Think about what that means. That is not a slow leak. That is a drain. That is a chunk of deliverable metal leaving the deliverable category fast enough that the market has to pretend it's normal just to keep operating. If you rewind a few months in the same narrative, registered was sitting around 167.7 million ounces. Then it was 150. Then it was 120. Then it crossed below 100. Now it's under 90. That's not a chart pattern. That's inventory being removed from the pool that backs the paper promises. And when you see a market keep advertising paper claims while the deliverable pool shrinks, you're not watching a healthy futures market. You're watching a confidence engine, because paper only works if the market believes most people won't ask for metal at the same time. February gave a preview of what asking can look like. In normal months, delivery rates are modest, 5%, 10%. A small slice stands. The rest roll, close, or take financial exposure. That's how the system breathes. But February was widely discussed as abnormal. The percentage of contracts standing for delivery was reported as dramatically higher than modern norms. Whether you call it 60%, 80%, 90%, the key point is that February looked structurally different. And now March is staring at a much larger base of open interest. Here's the uncomfortable equation. If even a quarter of March open interest stands, that's 32,600 contracts. At 5,000 ounces each, about 163 million ounces demanded. Against 88.79 million ounces registered. The math does not work cleanly. Not without the system doing what it always does when math threatens it, using the escape hatch written into the contract. Yes, there is an emergency door. And this matters because it changes how you interpret everything on Friday. A true default is rare because the exchange doesn't have to default. It can protect itself legally through emergency provisions. It can force cash settlement. It can say, here are dollars, you're done. That's not a Hollywood collapse. It's a contractual surrender. And the moment that happens, if it happens, the exchange can survive while its purpose is damaged. Because if a market that claims to price physical metal admits it can't deliver physical metal, the screen price becomes a cash reference, not a physical truth. That's where the world splits. Paper silver and real silver. Now bring it back to you because you're here for one reason. PSLV. PSLV is not a futures contract. It represents claims on allocated, audited physical silver held in a Canadian vault structure. The metal exists as bars. You can debate discounts, premiums, flows, but the underlying asset is not an IOU. And that distinction becomes everything when paper and physical separate. Think back to the last violent leg. The screen price crashed, sentiment broke, and at the same time dealers didn't hand you metal at the screen. Physical premiums stayed elevated. Some premiums widened. The paper price said one thing, the shelf said another. In that moment, PSLV traded at a sharp discount to NAV. People selling claims on metal for less than the metal was worth. An extreme discount in the same window where physical buyers were paying big premiums over spot for certain products. That spread is not sentiment. That spread is the market telling you it doesn't trust the plumbing. And as the panic cooled, the discount compressed. Not because scarcity vanished, but because emotion faded faster than reality. Now what you're watching into Friday is whether that compression continues, whether PSLV moves from discount toward flat and potentially toward premium. Because when PSLV moves from discount to premium, it's not a cute statistic. It's the market paying up for proximity to bars. In calm markets, people don't care. In stressed markets, that preference can become a stampede. And you do not need the world to end for that stampede. You just need enough participants to believe delivery is uncertain. Uncertainty is fuel. Now I want to talk about the part that most people misunderstand. A forced cash settlement doesn't make the problem disappear. Cash settlement is how the paper system protects itself. It is not how it replenishes metal. If you pay someone dollars instead of ounces, you haven't created ounces. You've just admitted you couldn't deliver them. And once that admission is made, the buyer who actually needs metal, industrial, institutional, or sovereign, doesn't say, okay, cool. They say, then I will source it elsewhere. That is how the physical premium explodes. Not from panic tweets, but from a supply chain changing its behavior overnight. And that's why Shanghai matters so much on a week like this. Because Shanghai is not just a screen, it's a physical heartbeat. It's a region where industrial consumption is real and relentless, and where a holiday closure doesn't erase demand, it delays it. Before the holiday blackout, there were already signs of physical tightness in Asia. Inventories on the Shanghai side were discussed as low, with reported levels near multi-year lows in the hundreds of metric tons range. Whether you track withdrawals, premiums, or nearby pricing behavior, the story was the same: urgency. Now that Shanghai is open again, that urgency doesn't politely return. It hits all at once. And today's price behavior, silver up while gold is down, fits the urgent bid narrative. Now, between now and Friday, there are 3 checkpoints that can change the temperature quickly. Checkpoint 1 is the daily vault report, typically posted after hours. Don't just look at totals. Watch registered versus eligible. Registered is the deliverable pool. Eligible is metal sitting there that isn't committed unless it's reclassified. If registered drains and eligible doesn't convert, pressure rises. If eligible converts to registered in size, it's the system pulling metal forward to meet demand. That buys time. It doesn't solve scarcity. And here's the detail that makes this week feel fast. If the average drain rate being discussed is anywhere near the high hundreds of thousands of ounces per day, then the difference between under 90 million registered and under 85 million registered is not a quarter. It's a handful of sessions. In other words, the clock is not measured in months, it's measured in days. Checkpoint 2 is the first full overnight sessions with Shanghai actively trading again. One session can be a reaction, 2 sessions can be a resumption, 3 sessions can become a narrative. Watch how silver behaves when Asia opens and liquidity is thin. Does the bid show up immediately? Do dips get absorbed? Does the market refuse to stay down even when Western traders try to push it? That behavior tells you whether the physical side is leaning or merely visiting. Checkpoint 3 is Thursday's updated March open interest. Open interest is the stack of promises. If it collapses into Thursday, someone is rolling out of the way. That can relieve immediate delivery pressure. If it stays high, the promise stack stays tall heading into the moment those promises can be tested. And here's the twist. The more people expect stress, the more some participants try to front-run stress. That behavior can reduce pressure, or increase it, depending on who is holding what and why. There are 2 kinds of players in this arena, those who want to avoid delivery, and those who want to force delivery precisely because it exposes the system. You don't need conspiracy to understand this, you just need incentives. If you think an exchange is overpromised, demanding delivery is the fastest way to find out what's real. Now let's talk about the word everyone throws around, default. What does it actually look like? It looks like a statement, a rule invoked, a settlement preference. It looks like a contract holder receiving cash, possibly with a premium, instead of receiving metal. Legally clean, functionally brutal, because an exchange exists to bridge paper and physical. When that bridge becomes optional, the market starts building new bridges elsewhere. That's why the nickel episode on the London Metal Exchange mattered as a precedent. The institution survived. The credibility didn't fully recover. The pricing authority became contested. Silver is even more confidence-driven than most people realize. It's not just supply and demand. It's confidence in deliverability, confidence in inventory, confidence in settlement. Now I want to pull you back to the human level for a second. A lot of people are exhausted. They've watched spikes, crashes, this is it weeks that turned into nothing. They've watched narratives get weaponized. So here's the clean reason this week matters. A calendar deadline tied to a contract structure, tied to a registered inventory number that has been draining fast. That's it. That's the core. Not memes, not drama, the math. If you want the final breakdown before the Friday open, subscribe. Short, simple, and it makes sure you don't miss the last map of this week. Now here's how to read Friday without getting played. If the paper price dumps on Friday morning, but PSLV holds its NAV tighter, or the discount doesn't widen, or it flips toward premium, what does that tell you? It tells you the physical reference point is holding while paper gets noisy. If paper dumps and physical premiums stay elevated, what does that tell you? It tells you the dump is liquidity theater, not abundance. If open interest collapses into Thursday and inventory stabilizes, what does that tell you? It tells you pressure is being delayed, not erased, delayed. And delayed pressure has a habit of coming back harder because it brings more participants into the room who now know what to watch. Now let's talk about why this week can get nasty. Volatility is a weapon. If you were a big paper short and delivery demand looked uncomfortable, you'd want holders to roll, close, take cash, stop asking for bars. Every contract that backs away from delivery is pressure removed from a vault that can't be refilled overnight. So expect turbulence. Don't confuse turbulence for resolution. And don't confuse a red candle for abundance. Here's the practical lens for PSLV holders. What do you own exposure to? Do you own exposure to a paper price that can be cash settled under emergency rules? Or do you own exposure to allocated metal sitting in a vault, audited as bars? Those are not the same exposure when the system is strained. And here's the uncomfortable truth. Most people only learn that difference after the fact, when the spread has already blown out. You're trying to learn it before. One more detail for PSLV holders, because this is where the signal gets clean. At the worst moment of the recent sell-off, PSLV was reported to trade at an extreme discount, double digits versus its net asset value, while physical products in the real world carried heavy premiums. That is the market screaming, "Paper is liquid, metal is scarce." Then, as the panic cooled, that discount was reported to compress into the low single digits. That's not just relief, that's the market drifting back toward the metal because the metal didn't magically reappear. So going into Friday, watch the discount/premium behavior like a heartbeat monitor. If spot chops violently but PSLV holds closer to NAV, it's telling you the physical anchor is firm. If PSLV flips to premium, it's telling you buyers are paying extra to get exposure that feels closer to deliverable bars. Now here are the 3 moments to mark because timing matters. First, the vault report after the US session, typically around the evening window. That report tells you whether registered is still bleeding. Second, the next Asia open. When the clock hits the evening in New York and Asia takes the wheel, watch whether the bid shows up quickly. If it does, that's Shanghai demand expressing itself. Third, Thursday night into Friday morning, when you can see where March open interest actually sits right before first notice day. If it's still heavy, the market walks into Friday with a tall stack of promises. Quick favor, if this is helping you read the week clearly, hit the like button. It pushes the breakdown to other PSLV holders before the deadline, and that matters more than people think. Now I want to hear from you because it tells me what kind of crowd is here. When you think about Friday, what do you believe is more likely? A quiet roll that diffuses pressure, or a visible stress signal that forces repricing? Drop your answer below, quiet roll or visible stress. Second question, if PSLV flips to a premium this week, do you see that as a warning sign or a confirmation sign? Tell me which and why. Now close this the right way. Focus, not frenzy. Between now and Friday, your job isn't to stare at every tick. Your job is to watch 3 signals. Vault report trend. Asia session behavior with Shanghai active. Open interest into first notice day. If those tighten together, Friday gets louder. If they loosen, Friday gets quieter. But the underlying scarcity doesn't vanish, it just moves forward. And remember what today already showed you. When Shanghai came back, silver moved even while gold didn't. That's the tell. Now we find out what Friday forces the paper market to admit. See you before the open.